Hey, what's going on, guys? Welcome back to my channel. In this video, I wanted to talk about my portfolio strategy just a little bit more in terms of allocation, as well as talk about some tech stocks that I'm liking at the moment. It is the start of 2021, and so we're going to talk about some of the positions that I'm building or have already built. So yeah, let's just jump right into it. So my account's down about $7,600 today, so to speak. I think the Nasdaq was also down just a little bit. And so I wanted to jump into some stocks that I'm liking. The first is what I consider to be a no-brainer home run, and that is Facebook. I usually don't show that many technical indicators when I'm talking about stocks that I'm looking at, but I wanted to highlight something which is RSI. So RSI is Relative Strength Index. It's just an indicator that shows relative strength of a particular point in time relative to previous points in time. So since this is RSI 14, that considers 14 periods at a time. And so you can think about it as undersold, or sorry, oversold is when we are near 30 RSI, and overbought is where we're near 70 RSI. That is totally, I would say, I don't know if arbitrary is the right word, but don't take this as a Bible, right? That doesn't mean, oh, I have to sell when it gets here, because obviously stocks can become overbought and stay overbought. And the other thing is that overbought and oversold are just relative terms. So it's not like, when people say, oh, RSI doesn't work because, when things get overbought, they can stay overbought. That's not the right way to say it. That because you're not using RSI in the right way. It's not like a clear-cut signal that says sell here, buy here. That's not what this is supposed to do, right? Ultimately, technical indicators are just filters that take in price action to, as I mentioned, filter out data and creates more simple data points, right? Because it's a lot more simple to go from here to here. But anyway, what I really wanted to highlight is sort of these simple buying opportunities, which are, stocks like Facebook, which are extremely high profit margin companies. Facebook is one of the largest software companies in the world, obviously. And so RSI at 30 plus retracing to the 200-day moving average is just an awesome, it's sort of like when there's a solar eclipse or something, right? Or some kind of when you can see a planet for an extended period of time, where it's sort of like the stars or the planets just align. So this is just an example of that. So you pretty much want to be buying tech stocks here. RSI oversold, same way. So I think the last time RSI was oversold was back in the March crash, where pretty much everything was oversold by RSI, of course. And so that was here. And then the last time we got here was probably, actually, so this doesn't count because we weren't at the 200-day moving average. And so this does count. And I wouldn't say counts, meaning that we have to bounce here. Right? This is not a prediction. This is more of a, hey, in terms of when I would or should be buying Facebook, this seems like a much better time to be buying it than other less obvious periods, right? And so there's a lot of sort of gray area in technical analysis. It's important to be able to navigate that, right? There aren't that many absolutes in life, period, right? So just from a probability standpoint, I'm really, really liking this setup. And so the last thing I'll say also is that you notice I want to really highlight this as well, because the other lesson that I want to share is that so Facebook was in this symmetrical triangle. But what I really want to highlight is that we talk about consolidations all the time, obviously, because we've been in the bull run. A lot of consolidations break out to the upside, but that's not always the case, right? Like obviously here we were consolidating and we clearly broke down to the downside. So um, once we broke down below this time period, it looked like we wanted to get back above it and consistently got rejected. And then this created some kind of bear flag. And then we had a drop, and then it looked like we still try to get, above this, and then we got rejected by that range again. And then we sort of just dropped here. And so that's something I want to highlight too, right? Is that consolidation isn't always bullish. And so now let's go ahead and take a look at my portfolio. All right, so I have about $20,000 in Facebook right now. I wanted to get something close to 100 shares so I can do covered calls and pay myself a dividend with Facebook. And so let's actually see my history with Facebook, because there is a little bit of a history, especially over the past, I don't know, year or so. Um, So whole bunch of buys kind of came in January 14th, which was yesterday. Once I saw that drop, I was like, okay, I have to get in. And then I was like, kind of thinking about how big of a position I should make it. And I even sold shares of some other companies so that I can make this more of a full position. And so, yeah, Facebook, I am happily building it out. My previous experience with Facebook is actually just buying and selling calls. So as you guys can see, I bought a call here, 255 strike, cost me about $3,100. And then once I sold about for about $4,100. So that's about pretty nice profit, right? $1,000 profits in just 3 days. And then also here, this same call that I bought, I profited about $1,700. That's over 50% return between September 22nd to October 12th. And so I do have a little bit of a history with Facebook, but I kind of wanted to just have it as a core holding, right? It's kind of hard to find this high quality of a company. Yes, maybe the growth is slowing down a little bit, but there's still a lot of upside, and it's just such a well managed company, in my opinion. And so, yeah, I'm totally prepared for this position to grow to, anywhere from 25, 30K if it needs to. So actually, I think this is a pretty great segue into my portfolio allocation strategy at the moment. So I basically have three different types of holdings. There's like a core holding where most of my money will go into these types of holdings. There's like a level two holding, which is something in the middle. And there's a level three holding, which is a little bit more speculative. Um, well, I don't know about speculative, but just not something that I'm prepared to make a level two holding. And so in terms of a level three holding, I'm usually okay with the $5,000 to $10,000 range for that. Usually $10,000 is probably more my limit for a level three holding. And so we'll go into some level three holdings right now or after Facebook. Facebook would be a level two holding where I would do anywhere from, let's say, $15,000 to $30,000 on a particular holding. That would be something like Facebook or Microsoft. And then a level one holding easily can exceed, 150,000, maybe 200,000 if I need to. Um, and so, yeah, so this is Facebook. And so I'm currently building it out. I should probably get the 100 shares sometime in the next month, actually. And the next company that I'm looking at is Zoom. And a lot of folks don't actually like Zoom or started turning bearish on Zoom because, well, I'll just repeat what people have said, right? Because since a big part of the reason for this run up was the work from home environment. If there is good news about a vaccine coming, then people are going to need to work from home less. And so there's less of a need for Zoom to be this expensive, right? And so that's the narrative. I just literally repeated what I've been hearing. And what I'll just say is that Zoom is a much better company at this price than it is at this price. Definitely needs to grow into its shoes. Once again, RSI at 30, and then we have the 200-day moving average support, just like Facebook. And so, yeah, I started nibbling right here. I want to take this time to make a full disclaimer that I am not looking at Zoom earnings reports or balance sheets or anything like that to make these investment decisions. I'm literally just going off of technicals. That's kind of who I am as an investor and as a trader. That's just my strategy. So this is not, none of this actually is financial advice, but especially not stuff like this, right? And so Zoom is a level three holding where currently it's about $5,000. At least my position is about $5,000. I believe the only time I started buying it was starting in, I want to say, December. Yes. Okay. So I also did a call debit spread back in November, turned about 1100 into 1365, but then I wanted to make it an actual position. So I started buying back in December and then here in January as well. And so I'm not actually sure how big I'll let this position get. I think I might just stay where I'm at, especially because I'm already up about 6%. And so, yeah, I'm totally fine with this going forward. And so that's stock number two. And stock number three is CRM, aka Facebook, another high profit margin business, mostly software, really great management, really great sales team, hovering here around the 200-day moving average. And so I couldn't help but start buying more and more of this company. And so currently I am down on Salesforce. I'm currently down about 3%. My position is about 7.8K, but as I mentioned, level three positions can go anywhere from 5 to about 10K. So I'm not at a full position yet. I would not want to put more than $10,000 in Salesforce with the portfolio size that I have. But I will be perfectly fine with averaging down if we keep going down, right? I'm probably going to buy more shares next week, for example, just to average down a little bit. And as far as my history with Salesforce, I think this is the only time I've been buying it. Yeah, pretty much. So started in December and then all the way from here into January. All right, and so that covers some of the more obvious plays, I would say. I do want to talk about some other bonus plays in terms of large cap tech, just to kind of make this a more well-rounded video and just talk about what I'm looking at. So the next in terms of the bonus is actually Netflix. So Netflix has been consolidating in the sideways range, getting close to the 200-day moving average, and then obviously we have some pretty nice support at this level as well. So yeah, for the most part, Netflix between 2018-ish to about 2020 was sort of just consolidating within this range, just going sideways. Finally broke out above that, had a few retests, and then broke out of this range, and then has some more retests. And so it is consolidating sideways. I don't know if 2021 is going to be the year where we would break out of this. It's entirely possible. I think about something like Amazon, for example, where it sort of seemed like once we broke out of this range initially, it was like, okay, it clearly cannot go that much higher, but then it had like a few more gears to go. And so completely just destroyed everybody's expectations of how much Amazon can grow. And so I think Netflix is totally capable of doing that as well. Bonus stock number 2 is Microsoft. When I think about Microsoft, I think about a similar picture actually. Let me go ahead and draw a rectangle. So Microsoft is no stranger to consolidating sideways, especially after really strong moves. At the moment, I think we are also consolidating sideways, just like we were here back in July 2019. And so yeah, Microsoft is no stranger to this and totally fine to do this, especially after the run up that it had. And so I am anticipating Microsoft to break out to the upside. I do have a position in Microsoft and Netflix. And so, yeah, wanted to shout these two out. Now, I also wanted to talk about Tesla. It's not necessarily a tech stock, although it depends on who you're talking to. It is a tech stock. But I wanted to talk about this because I don't think I've ever shared my thoughts on Tesla too much. I've never really tried to call a top on Tesla on my channel, and nor have I outside of my channel, I guess, either. It's one of those stocks that is extremely hard to bet against. But I did want to share my thoughts a little bit. I was doing some projections earlier, and I feel like the anywhere from where we just topped here to sort of the $1,000 range would be an area that I think could create some trouble for Tesla if we haven't already. Like obviously, we were in this range. Looks like we're breaking out of it. Not the end of the world. I wouldn't be surprised if this just ends up being like a breakdown, obviously, but ends up picking up more buyer support if we do end up heading lower. So this alone is not the end of the world, but I don't have the projections right here. But in terms of what I'm seeing, in terms of projections, I think anywhere from now to the about $1,000 range would be would be an area I'd start to, if I had to call a top, I would call that. But by top, I don't mean like Tesla's going to go to zero after that. I just mean an area that could potentially present some trouble, where we'll see something like a larger pullback. Obviously, Tesla is no stranger to somewhat large pullbacks. Like even here, for example, this was a pretty beefy one. It's like 30% in like a couple weeks. So it's no stranger to that. But the point is, I wouldn't buy Tesla unless it saw something like that. And so that's going to be an area that I'm watching out for. If anything, the reason why this is relevant to this video is because Tesla is a stock that I am watching, but not necessarily buying for 2021. But if we do end up seeing some kind of correction, then I'll have to consider buying it. And then in terms of how big I want Tesla to get, so I've swing traded Tesla before, never really held it for too long, but I think I'd feel comfortable making it a level 2 position if I'm being completely honest. But again, it'd have to be a pretty good buying opportunity because Tesla isn't really like my strategy traditionally. And so, yeah, I kind of wanted to share that as well. In terms of where the market is at, obviously it looks somewhat scary because when you kind of zoom out, it's like, wow, the Nasdaq just literally did 80% in less than a year. So it does kind of seem scary. The only thing is that the Nasdaq, for example, is breaking out of this base, and so I don't think it's going to end that quickly. This is a spot that I have for when I'll consider taking some profits, not necessarily all my profits, but just some profits. We are slowing down a little bit, and one thing I'll say that's not helping is definitely a really low put to call ratio, and so folks are getting somewhat bullish. The last time we had a put to call ratio this low was in very early December, and so the days leading up to that, we actually saw a pretty significant drop before actually moving higher. And so I think, yeah, that's part of the reason why market's having a pretty tough time to actually make significant progress. I mean, just look how choppy this is, right? I mean, yes, the overall trend is still up, but it's not a very clean trend, like something like this, for example, where there's still a lot of bearishness in the market. And so, like, for example, if the put to call ratio was somewhere up here, I would be so bullish. Um, but obviously that's not the case. But anyway, so yeah, overall I'm still bullish on the markets. One thing I'll say though that's good at least is that it gives a chance for the moving averages to catch up, meaning we're creating less overbought signals the more that we consolidate sideways, and that's why consolidation is so powerful. Like for example, just think about, let's say, so the price we're at right now, which is at 310, 311. We also were at that price in mid-December. This is December 17th, right? And so we were approximately 18% above the 200-day moving average at this point. But look how much the 200-day moving average has grown actually since then. So for example, we are only about 14% above the 200-day moving average at this point, right? So less of an overbought signal. The reason why that's important is because, in my opinion, stocks kind of hug their moving averages, as well as the moving averages kind of follow stocks, obviously by definition. That's just basic math. But I do think price action um, tends to use moving averages as support, and then the overbought signals that are my favorites are the ones where the market really starts to go parabolic and doesn't necessarily respect the moving averages that much, like gets a little bit too far away from the range and eventually just snaps back to reality at some point, right? And so that's the only good thing about what I'm saying right now is the consolidation that we have is creating less drastic overbought signals. And if I can leave with some really cool advice, something that I've been sort of thinking about is, like, in terms of calling tops, um, it's very difficult, right? And there's only two types of tops that we can actually call. One is extremely overbought signal, which it generally tends to be a little bit more easy to call. But it's hard to know like when stocks are going to go parabolic. But still, it's a good signal to say, hey, maybe I shouldn't really be adding at these points. At the moment, we're not parabolic like we were, let's say, in September, or heck, even in March 2020, um, or let's say January 2018, where stocks really sort of took off, right? And so what I'm trying to say here is that there are going to be tops, like significant tops, where we don't necessarily go parabolic, where it's the parabolic nature that didn't lead to the top. Like, for example, we weren't parabolic here, right? And this was like a 20% drop. We weren't parabolic here, right? And this was like a, I don't know, maybe 10-ish, 20 to 15% drop. And so, so like right here, this was not parabolic, right? This is a sign of momentum sort of slowing down. And so a potential top signal is obviously parabolic moves. Another potential top signal is actually if we start to slow down and there tends to be less market participation. For example, back here in 2015, there was a clear bearish divergence because the rest of the stock market was not making higher highs, whereas some of the major indices was, and so there wasn't enough. There was awful participation, awful breadth going on. And so this is something else to sort of keep in mind, right? It's not like an end-all signal, but it is something to keep in mind, something to be cautious of when stocks start to slow down. And then the other thing that I want to say is previous, like really significant areas. So this is going to be signal number 3, because signal number 1 was parabolic move. Signal number 2 was lack of participation. Signal number 3 is previous areas of significance, right? And so this is the Nasdaq. Like for example, here in 2019, we were clearly, having some difficulty getting back above this. But once we did, it's almost like the fear was gone, right? It's like, okay, everybody, new all-time high, no reason to be scared. Let's start to scale into some longs here, and it ended up being the perfect trap. And so That's another thing to be cautious of, right? Like heck, even here we only barely got above this range just slightly before we ended up experiencing some kind of rug pull. Same thing with here, and the same can be said with the S&P 500 as well. Um, One that's see like right here, right here, right here, and something that's less obvious is sort of like really big trend lines, for example, like this one, where it looks like we're starting to use this as support now. But I think I also thought this was going to be an area of significance, and so this is example number three, right? Whether it's a previous all-time high or an area of significance, it's just a matter of, hey, maybe I should pay attention to this move a little bit more. In fact, what the Nasdaq did back here, the S&P is sort of doing up here, where we sort of it was like, okay, the market stalled here at all-time highs for a little bit, and then once we eventually broke it, it's like almost like all the fear went away. It's like, okay, everybody, it's time to buy now. There's no prior resistance, right? It's just a clear breakout. But this sucked in a lot of buyers, right? A lot of if you look at data, a lot of calls were being bought at this point, especially on large cap tech stocks, and so that obviously led to a rug pull. And so yeah, I wanted to share those three tips for calling tops. If all of them don't make sense, just feel free to you know, leave me a comment or something like that. I guess the last thing I didn't say is optimism, right? If you look at sentiment data and it starts to get extremely optimistic, then that's something to keep in mind, like euphoria, right? And that's basically what drives markets, in my opinion, is those two types of emotion, which is euphoria and fear, and everything in between is sort of what creates the stock market. We focus a lot of times on the stock part of it, where it's comprised of hundreds and thousands of companies, but less on the market of it. I like to focus more on the market aspect because ultimately a stock market is a market driven by buyers and sellers. And so, yeah, with that, it's important to understand the psychology of buyers and sellers, in my opinion. At least that's what I try to use to my advantage. Everyone has their own strategy, but that's just what I do. Um, so yeah, I think this started off as like a stocks on buying video, then turned into a portfolio video, and then turned into a how to call a top video. But I think that's okay. I'm all about pouring in a bunch of information into my videos, and yeah, let me know if you guys like this video. I'm pretty proud of it, and yeah, I'll see you guys in the next video.